Victor Wang, Senior China Bank Analyst at Macquarie Securities. Many thanks for joining us this morning. Thank you. China banks, busy, BOC missing, ICBC was perhaps the blowout number. Overall, people are talking about, Victor, they're talking about the bad loans, the credit bubble. This is the sort of overhanging, very unpleasant cloud, isn't it? But the earnings are good.
Actually, this reaffirmed our view. We have been bullish for quite some time, and it's very happy to see the numbers really deliver. I think the key message, people look at China Bank's earnings, they don't really care that much about P&L, because everyone knows they are making good money. But they look at the asset quality numbers very carefully. And if you look at all the banks' reported numbers, on a quarter-over-quarter basis, believe it or not, everyone's NPL is dropping. That's the most powerful message, I believe, I find.
What does that say there? Because if that's dropping, that is pretty bad news for the next 6 months, isn't it?
No, the NPL, the non-performing loan, is dropping, means at least for the past 3 months, we do not witness any sizable deterioration of the loan book, which is great, especially for banks like China Minsheng Bank. That is a bank that are doing quite a lot of ACME. Remember, ACME loans are very, very short in terms of duration. Every month we are talking about almost 15% of the loans need to be paid back, which means in 1 quarter time, we are talking about almost half of the loan book will get renewed. Even with such repayment, we haven't seen NPL popping up. That's, to me, a very positive message.
Valuations and risks. Now, to put those 2 words in a sentence, valuations are clearly right there because you had the Chinese State Investment Authority buying shares in the 4 biggest banks. But then some are saying they bought those shares because there are risks involved.
I think that is some move for them to boost investor confidence. The reality is China.
Why would you boost investor confidence?
Because I think the market is unrealistically pessimistic for the sector. I would say China banks have very strong earnings and a clear, still expanding economy, which is a great operating environment. Yes, we have some volatilities, but overall we still see a quite rosy picture.
Okay, rosy picture, second half though, looking at your notes, it isn't quite so rosy. I'm going to give some examples in your notes. Tougher liquidity control measures, fierce deposit acquisitions, dropping property prices, fragile global economy recovery, SME failures, small and medium-sized enterprises, and a slim chance of equity raising. That's quite a few points to have a non-rosy picture, isn't it?
All these things are happening as of today. But the reality is, the big picture is, we are close to the end of the tight liquidity control. We will see China gradually loosen, both on monetary policy and arguably also on the loan quota control. So you will gradually find companies have more money to operate. You will gradually find the economy will gradually stabilizing, and these are vitally important for banks' operation.
So some investors, Victor, saying that some of these banks are heavily exposed in the debt scenario. Not quite like Europe, but heading towards that kind of experience of overexposure in debt. They are, as you say, unrealistically pessimistic.
I think several numbers, let me give you. Number one is China banking regulator, CBRC, has the regulation that no bank can operate on a loan-to-deposit ratio of higher than 75%. In other words, not a single bank in China is operating depending on external wholesale funding. Everyone is self-dependent on deposit. That's basically day and night difference compared to European and US banks. The other thing is, for most of the China banks, over 95% of their operation is in China. So they have some, but very limited exposure to overseas market. And lastly, China banks are not allowed to invest into the equity market at all. I cannot see any short-term huge deterioration from here.
Victor, we discussed before the break, just your upbeat about Chinese banks. Many have been saying the bad loan concerns is definitely one to avoid the banks. But just going through your notes again to remind the viewers that, of course, your concerns are indeed about liquidity control measures going forward, fierce deposit acquisitions, dropping property prices, which is a big issue, credit bubble, property bubble, the fragile economy in the recovery. Also, your concerns are they're going to face a challenging operating environment. We therefore expect banks will understandably, you'll quote your words, behave conservatively. Yet you are saying words that are very upbeat to me, but your notes are saying beware.
The background is China banks in the first 3 quarters typically have made more than 80% of our full-year earnings estimate. Imagine if you are chairman of a bank, you have already
I wish.
ahead of the budget in terms of P&L operation. At the same time, you are facing really a lot of moving parts in front of you. Your natural behavior will be, I will slow down a little bit so that I can make sure I do not make a big mistake, which is exactly happening in China. So we do believe China banks will be de-risking a lot of their portfolio. For instance, all of the banks have been very conservative in terms of underwriting new loans to developers. When that happens, together when the M2 substantially decelerated to 13% last month, I think PBOC, the central bank, now have to make some adjustment because they realize the main fund channel, which is the bank loans, is not really going to go very strong anytime soon because banks are playing safe game. At the same time, M2 is slowing, so they have to loosen a little bit.
ICBC shares in pre-trade are up 5%, Victor. Is that, of all your banks, your most favored bank?
Among large ones, yes, it is. Among smaller ones, we like the SME player Minsheng.
Thanks for joining us there. Victor Wang there,
Thank
joining
you.
us from Macquarie Securities there.